A lot of the times it feels like we have a lot of money and then magically it's gone. Now, it may not be true that I'm a very good magician, but it is true that the biggest expense that you have and why you lose a lot of your money is because of taxes. So right now, I'm going to teach you how you can keep more of these so you can save and invest and continue to grow your wealth and achieve financial freedom, or just do what you want with your money. And in this video, I'm going to go over tiers for the most achievable ways for you to pay less tax over time from someone who is just a W-2 earner, paying a little bit less to the government, and then if you were to own your own business or other assets that allow you to pay virtually $0 in taxes. The first tier would be if you were a standard W-2 or 1099 employee and you were working for a company. And this is going to be the bucket where a majority of people fall. So you might go to work, get your paycheck, spend it all, and feel like you gave a lot of it to the government every single time that you're getting paid. Roughly each person will work for the government for about a third of the year, meaning that each of your paycheck, you're paying somewhere between 20 to 40% of your paycheck to the government, depending on your earned income rate. If this is the bucket that you fall in, there are three main things that you can do in order to pay less taxes. That first one would be taking advantage of your 401k or IRA account. So every single time that you get paid, either through your employer, there might be a 401k that they will also match and you get some free money, but you can put your money into that account. And now this can come from either a traditional or a Roth IRA. So with that employer, either you're putting your money into a traditional or Roth 401k. With a traditional, it will be pre-tax income. With a Roth IRA, it will be post-tax income. Now there are benefits to each. With the traditional, you can take a tax deduction when you're putting your money in there, but with the Roth, the money is already taxed and then it will grow tax-free. So not instantaneously will you feel like you're paying a lot less taxes, but over time, as you're building towards retirement, financial freedom, having money in, for example, a Roth 401k that is increasing, and by the time you utilize it when you're older and retired, then you can take that out completely tax-free. The next example in this tier would be utilizing a health savings account. Healthcare expenses are insane in the US. I recently went for a physical and got some blood drawn, and they charged my provider over $750, and I had to pay $200 myself for them to just ask my height and weight, take my blood pressure, and draw my blood for what felt like a total of 20 minutes. And I was waiting more than the amount of work that they actually did and were talking to me. So healthcare is obviously a very expensive cost, especially in the US, but there's a way that you could utilize your health savings account and high deductible plan to pay less tax. Now, this looks like you utilizing your health savings account that is paired with a high deductible health plan. And this is a very simple thing to do. And oftentimes, similar to your 401k, your company will match some or all of the amount that you contribute to this specific account. So your health savings account, usually once you have over $1,000 or $2,000 in it, you can have it grow in some type of investment. So the way a health savings account works is you're able to take distributions from it to pay for healthcare expenses. But something that you could do instead of just taking from it when you have a simple expense like mine, the $100 to $200 to go for a physical, which I still think is insane, you could just take that money out of your pocket and then have that money be invested in your HSA instead of withdrawing from it. Let it grow for the 30 to 40 years, and then 30 to 40 years later, as long as you've kept your receipts, then you can withdraw that money from your HSA. Now the key here with your HSA is because you're putting pre-tax dollars in, and as long as the medical expense, you pay with pre-tax dollars, but they do not specify when you actually have to take that distribution for the healthcare that you receive. So you could receive healthcare when you're 25, and then take that amount of money out when you're 65, and because you let those $200 grow for 40 years, it's now worth a lot more money. It grew tax-free, you take it out tax-free, and spend it tax-free. The third example would be tax loss harvesting, and this is when you take some of your investment losses and offset some of your investment gains. Today, you're allowed to take $3,000 of your investment losses. This means you actually have to sell, not just paper losses. They have to be real losses because you have to realize them and sell and offset some of your investment gains. So in 2022, stocks lost some value and some money. So people could have sold those, taken the $3,000 taxable deduction, because that is the maximum amount that you can get with tax loss harvesting. And then you can carry it over from year to year when you may have some actual gains of sale of stock that you have. The next tier would be if you have a side hustle or business, and as we're moving up, you're going to be able to take greater and greater tax deductions because the tax code is written for people who invest in assets, so the government doesn't have to, and people who own their own businesses because they are adding to the economy, which is why the tax code is written this way, because the government is incentivizing you to put more money in the economy. As soon as you have a side hustle or a business, you've opened yourself up to far more deductions that you just don't have when you were a W-2 employee. And you do not need an LLC or an S-Corp or some other type of business entity in order to take these deductions. You can just be a sole proprietor. So how you're watching me right now on YouTube, there's a camera in front of me as well as some lights around me, so my face looks a lot prettier, and all of those things I can deduct against the income that YouTube pays me for when you watch that ad all the way through in the middle of this video. Any ordinary and necessary expense that you have, you can deduct from your business. So let's say I made $50,000 last year from all of social media and had $15,000 of expenses. Instead of paying tax on $50,000 earned, I pay tax on $35,000 earned, which will save me a lot of money in taxes. But it has to be an ordinary and necessary expense. I can't just buy something absolutely random that doesn't make sense towards my social media business and deduct that. Two other awesome examples here would be a mileage deduction. So for example, when I go drive to my rental properties, or I'm just going to drive to Home Depot to get something from my rental properties, I'm able to deduct that mileage. So I use an app called Everlance, and this is not sponsored, but it's really great for tracking my miles. And on January 1st of every single year, I take a picture of my car mileage, and on the end of the year, on December 31st, I take another picture of my mileage. So I'm just assuming all of those miles are personal because this is still a personal vehicle for me. And then I track all of my business miles, so going to my rental property, and then whatever percentage of the amount that I drove for business would be considered business expenses. So all the gas that I have throughout the year, any oil changes, insurance, all of those other costs, let's say 30% of the time I drove for business expense or business miles, I can take 30% of all of those expenses I just spoke about and deduct them from my taxable income. And the last example in this tier would be your home office deduction. Currently, I'm sitting in my home office. It has a desk, and it is in my personal home. So that's how I'm able to take a home office deduction. It is my place of business, but it is inside a primary residence. So the portion of square footage that my office is, I can deduct other things like utilities, internet, any necessary home repairs, and take that against my taxable income again, and not just pay for them out of pocket. So it is helping lower some of my taxable income. The important thing to note here is it can't just be a table in your kitchen. You need to have a dedicated office space with a desk. That's going to be very important in case you were ever audited. The third tier, in order for you to pay less taxes, would be through real estate. Now, the tax code is written for real estate investors because the government is incentivizing you to create more housing because they do not want to do it because, one, they would do it inefficiently, and a lot of the times government housing is pretty crappy and not very well maintained. Real estate income is awesome because it is considered passive, so any type of passive investment activity that you have or passive income that you earn, then you can deduct any sort of losses from any of the gains that you have. So let's say after a couple of years, my rental property is now earning $1,000 a month. If in that same year I purchase another rental property because I'm earning so much money now, then I'm able to take any of the losses from year one, because oftentimes in year one, you're going to see a lot of losses on your rental property because you're purchasing it, you might be doing some renovations or other upfront costs in order to get it stabilized. All of those costs you can utilize to offset some of the income that you're earning from cash flow on that already stabilized property that is earning you some good income. And similar to owning a business or having a side hustle, any ordinary or necessary expenses with your property you can deduct. So travel expenses for me to go visit my properties in Boston, the car that I'm renting in order to get to and from the property, those are all things that I can actually deduct. And of course, any of the work that is being done on the property. And then the last awesome benefit with real estate would be depreciation. So with depreciation, everything in your property has a useful life according to the IRS, and a simple straight line depreciation method would be 27.5 years. So all of the things inside of your property are depreciating over 27.5 years. And for 27.5 years, you can take those same depreciation deductions on your taxes and pay less and less money. And I know I said lastly, but two other awesome benefits with real estate, which is why I think you should get involved with this and why I have, would be a 1031 exchange and a cash out refinance. With a cash out refinance, if you do one and you have $100,000 of equity that you can take out, you can receive a $100,000 check, and Uncle Sam can't take any of that money away from you, and you can utilize it to invest in more real estate. With a 1031 exchange, essentially you are selling your property and exchanging up into a bigger or better property that hopefully will earn you more cash flow. And normally when you sell a property, you're going to be paying tax on the profits, but you can defer those taxes on those profits into the new building alongside all the depreciation you took with this one building, and then continue to not pay taxes. The fourth and best tier where I see a lot of people pay absolutely $0 in taxes would be when you become a real estate professional. Now, when I spoke about when you got into real estate, you can offset your passive losses from your passive gains. But when it comes to having that real estate professional status, you are allowed to offset your passive losses from your active income. So for example, if you are a married couple and you are filing jointly and one spouse is someone who goes to work and they're making $100,000 a year, and maybe they're paying $30,000 in taxes, and the other spouse is a real estate professional and you had $30,000 of losses in that exact year for a specific property, then you're able to take those $30,000 of passive losses and offset all of that active income, meaning a fat refund in your pocket and pretty much no taxes paid to the government. You could theoretically do this as a single person. There are just some rules that you have to follow in order to hit that real estate professional status. You have to have 750 hours a year of actual work in real estate related activities, and it also has to be your number one primary job. So if you have a W-2 job, it can be pretty difficult for you to show, hey, this is actually my second job, it's my side hustle, and real estate is my main thing. I know some people who have taken it and it's worked out pretty well because they own and do a number of things in real estate while still holding that W-2 job. Or you could be someone who is a real estate agent and you are earning active income as a real estate agent, but you are also investing, so any of the commissions that you earn in your real estate agent business can then be offset from any of the real estate activities that you are doing. A similar thing is available for Airbnb operators, where you can offset some of your active income from any of the active losses that you may have in your short-term rental business, because being an Airbnb operator is considered active as long as you're doing it for 500 hours of the year, and each of your stays is considered less than 7 days on average. So pretty much the same thing as a real estate professional, but a little bit easier to get and claim that status on your return. There you have it. Those are all of the ways that you can pay a lot less taxes, and there are far more out there. But these are 4 very achievable ones for a lot of people because most people have a job. It's very easy to start a side hustle where maybe you could sell stuff on Etsy or make YouTube videos, social media, and buying real estate is now more attainable than ever, especially if you could do an FHA loan house hack. And if you want to learn more about that, so you could buy your first rental property for very little money down, check out the link in the description below. And personally, I am trying to make my way towards that real estate professional status so that I can combine my income with whatever Mia is doing once we start filing together and offset a lot of her active income. If you guys like that video and you want to make sure you never get audited, please go down and hit that thumbs up button. Obviously, that won't guarantee you won't get audited, so I just want to make sure I say that before you think that will mean anything, but I would still appreciate it if you would like the video for the YouTube algorithm. And if you want to learn different ways where you can save, invest, achieve financial freedom, and just build your wealth in general, definitely hit that subscribe button. And if you don't follow me on TikTok and Instagram, would really appreciate that as well. So thanks again for watching, and more wealth is coming your way.